Here's what our guests have been saying about US stocks as we head into the new year.
You've got all the ingredients here for a classic melt-up.
Melt-up scenario in the first half of the year.
Catalyzed by the UK election results,
the acceleration of the data,
improvements in the US-China tariffs.
Look at the liquidity.
Well, that's a pretty good cocktail.
There's still risks out there.
If we don't start to see an earnings turnaround,
can these stocks actually deliver the earnings growth that's being expected of them?
You could easily have some election year disruptions.
the election's going to become front and center.
Investor attention move away from some of the political concerns.
Right now, it doesn't look like there's anything in left field to come at us.
Investor sentiment, they're bullish.
Can't be too bullish or bearish at this point.
We're going to see this FOMO environment become an issue.
It's hard not to see room for a potential overshoot,
where we start fearing the fear of missing out.
Joining us now for the hour is Paul Markham, Global Equities Portfolio Manager at Newton Investment Management. So gains of more than 20% in the S&P 500 for the year, Paul. We're looking at a gain of some 3% for December. Is this a melt-up?
It feels like we could be at the beginning of one, but there are some good reasons to sort of look into next year and feel that maybe some of the headlines that come around both politically and particularly around US-China trade wars could sort of derail that somewhat. So I think earnings will be very important as we go through the year.
Yeah, and what's interesting about earnings, when people show concern that earnings and the level of the S&P 500 have perhaps become divorced, is that actually, isn't this the whole point, that equities kind of front run what we're going to see out of earnings? I mean, research has found that stock returns lead S&P earnings by a quarter, and very big years in markets rarely come right before recession. So should we actually be worried about the fundamentals right now?
Well, we're in a very different scenario and a different backdrop to what we've seen in previous cycles, and this cycle has been long. It's been relatively flat, so we haven't had the same sort of sense of a rate cycle driving creative destruction, the sort of sharper difference between trough and peak of interest rates. We've not seen such a strong economic bounce as we've seen in the past from recessionary levels in 2008, 2009. And those things taken together mean that, in a sense, there has been leadership from the market ahead of the economy, but on a much longer term basis, several years really worth of that before the economy really started to respond. And that gives the sort of feeling that the market is dragging the economy kicking and screaming and slowly re-rating. And that's something which we haven't really seen before. So how that kind of reacts in the event that earnings don't react, I think is going to be really important and really interesting to see.
And what does that mean for how you would want to allocate to US stocks in 2020 then?
Well, I think the big question there really is whether or not we have the growth value rotation continuing that we saw in the fourth quarter of 2019. And certainly the growth stocks had been very strong for many, many years, and they got sold off in favour of more economically cyclical names. And if that continues, which will be largely driven by data, then we could well see the overall indexes really shift towards that kind of market-driven, more cyclical kind of rally, and that could give the overall market some more legs, as it were. However, if we don't see that happening, then you will start to see investors sort of retreat back to more reliable earning streams and potentially more dividend yield, and that will be something which overall for markets would probably be less of a kind of extra leg of growth going forward, I would say.
Right, and so if the attention does turn more to sort of dividend yielding stocks, are there other parts of the world that look more attractive to you than the US?
Well, certainly on a straight dividend yield basis, several regions are more attractive than the US, not least Europe, the UK. Certainly, and leaving aside everything else which is happening in the UK, certainly that would be an attractive aspect of UK listed equities. And emerging markets largely as well, particularly in Latin America, where there are some very high dividend yields as well. But again, those dividend yields are high for a reason, which is that rates are structurally higher, commodity exposure is higher, and political risk is also elevated. So I think all of those things are being priced relatively effectively. I think within the US, stocks which have a dividend yield have historically not always been in industries which the US investor has typically been that interested in. The US investor likes top-line growth, really, rather than bottom-line growth necessarily. And that's something which I think would certainly be difficult for certain sectors, not least some of the ESG challenge sectors, to do better. So I think sort of healthcare would certainly look a good bet in that environment. Good
in the US?
Yield, in the US, good dividend yields and so on. And elsewhere, I guess if you want more cyclicality, particularly in places like Europe and emerging, then some of those high-yielding stocks can give you that as well.